Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello. Welcome to Reverse Mortgage Radio. I'm really glad you're here today because we're going to be talking about something, I guess it's the concept of debt and people's viewpoint of debt and how sometimes selling assets looks like, from a certain perspective, that it's better to sell an asset than it is to acquire some debt. And we're going to talk about that because I read an article recently by Brady Mullen. Brady is a friend of mine. We worked together for a while. He's got about 19 years experience in accounting and financial planning industries. And his whole goal, he likes to empower individuals to make informed decisions. He began in the world of financial planning. He was a financial planning accountant and all this stuff. But basically, he's on a mission to help people gain clarity in their real estate decisions by demystifying, I guess, numbers and graphs. And now Brady's not a guest on the show. He was a few months ago, but he wrote an article that I want to talk about. I'm going to read the whole thing for you, word for word. And we're going to talk about it because I think it's an important article in that he addresses this concept of looking at debt versus spending down assets. And that's kind of the whole concept of the article. If you have any questions about this, please feel free to call me. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage in Denver. And you can reach me directly at 303-513-2748. 303-513-2748 is my phone number. You can also visit me online at reversemortgageradio.net. Reversemortgageradio.net is the website, and you can go there and download my free consumer guide. You can get a free quote on reverse mortgages, and you're not going to get a bunch of calls from a whole bunch of other people. It's just my site. And the quote on there is it's pretty accurate overall. It's probably a little more conservative than real numbers. In other words, if you go there and you get a quote, I could probably do better than what the quote is going to say, okay? Because I'd rather under-promise and over-deliver, if you will. But let's jump into this into this article. Brady, he wrote this just this week, and he starts out, he says, "It's no secret that reverse mortgages have had a rough start. I believe the ultimate reason for this is not that reverse mortgages were fundamentally different in the past than the reverse mortgage of today." The whole thing, in quotes, he puts, "not your grandfather's reverse mortgage." Clearly, though, there's been meaningful updates to the HECM features and protections over the years. HECM stands for Home Equity Conversion Mortgage. That's the FHA-insured reverse mortgage product. There are non-FHA insured loans, and depending upon your situation, I offer both HECMs, which are FHA insured, and non-FHA insured, which are called proprietary. Depending on your circumstance, we can fit you into one or the other. All right, back to the article. But he says it's still the most underappreciated financial tool that he's seen in 19 years of financial planning. So selling it like it's different than in years past, which is a strategy that I've seen a lot in the industry, is not working. It's not a different product. This is me again now talking, okay? Reverse mortgages, just so you know, have been around since 1989. Ronald Reagan actually signed the bill in 1988, and the first reverse mortgage, the first HECM, Home Equity Conversion Mortgage, insured by FHA, was originated in 1989. The whole concept of the reverse mortgages has been around since the 60s, and I've talked about that. I haven't done the history of reverse mortgages in a long time. I should do a radio show on that just to show all the changes that have happened. But the overall concept of the program is the same. You get money from the reverse mortgage. You never have to make a payment on it. As long as you live in the home, pay your taxes and insurance, maintain the home, and keep your name on title. And as long as you do those things, no payments ever due, but you're still charged interest. That interest gets added to the loan balance. So over time, if you choose not to make payments, and more people are making payments these days, but if you choose not to make a payment on this loan, the loan balance will grow over time. And that's the whole concept of it. That has not changed in all the years since the 1960s, and especially since it became an FHA program in 1989. That concept is still the same. But now let's go back to the article. Okay, Brady says, I believe the problem is that thinking of debt as a useful tool, which very much it can be, will always challenge people's intuitions. This is the fight the reverse mortgage industry needs to address. Now, also, too, just a quick note. Again, I keep interrupting myself, and it's going to continue for this whole show probably. But this article is written for other loan professionals, other reverse mortgage professionals. It's published on a website called HECMworld.com. And I'm going to link to that website on my blog post on my website. When you go to my website, next week is when we post these shows, usually by Tuesday or Wednesday at the latest. It'll be up on my website, and down below the description of the show, you'll see the link to this article on HECMworld.com. All right. Now, what he does here, Brady, he talks about this example. He says, here's an example that illustrates what I mean about the debt issue. Imagine a 75-year-old couple planning to celebrate their 50th anniversary with kids and grandkids. They plan a big memorial trip, and they budget $50,000. They distribute the $50,000 they need from a $500,000 brokerage account to cover the cost. So the account that was $500,000 is now $450,000. Assuming that this trip is affordable for them, does anyone fault the couple for taking this trip to celebrate the legacy they built? I sure hope not. If that's not a worthy use of investments at this point in their life, what is, right? So they take the trip, and everyone has a fantastic time. Over the next decade, the entire family mentions it often with fond memories. They have no regrets. Let's say that over the same decade, that remaining $450,000 brokerage account doubles. So this is basically, if it grows at 7.2% annualized, which is not unreasonable, it'll double to $900,000. Indisputably, they are less wealthy 10 years later to the tune of $100,000 for having gone on that trip. If they'd left the $50,000 in the account instead of celebrating their anniversary, the account would have become worth $1 million because they never would have taken that $50,000 out, and that $50,000 would have doubled to $100,000. Is this clearly true? Yeah, it is. Should we always avoid spending money for this reason? Of course not. It's just something we must consider when we spend money. And this concept is always relevant, not just in retirement. You have to decide, and now this is me talking again. So you have to decide if you want whatever it is your money's willing to buy, or if you want to keep your money. Which is more important to you? Is that new sports car, when you're, say, 30 years old, or you're going through your midlife crisis? Is that more important to you than the $50,000 that it would cost to get that car? It is for me. I mean, it's not for me, excuse me. I've never valued cars that much. Other things are important to me, but not cars for some reason. I like old cars, old vehicles. And in fact, in retirement, that's one of the things I want to do is fix up an old Ford truck, like probably 1970 Ford F-100 or something like that. And I enjoy those older vehicles. But let's continue on here. So now he goes to the next section of this article, which is to spend or not to spend. Here's where it gets interesting, though. What if they borrowed the money instead, that $50,000? Whether it's with a reverse mortgage or some other loan that's not relevant in this situation. It's the loan that causes our intuitions to scream. In this alternative scenario, they borrow the money and never make a payment on the balance, allowing it to increase. Most loans don't work this way, but such a thing is possible with a reverse mortgage. And what if that balance over time, over that same 10 years, accrues at 7.2%, which is also reasonable, from $50,000 to $100,000. So now this is me again. What he's saying here is instead of taking the money from the other assets, the $50,000, they get a reverse mortgage for $50,000 and they access that money and they never make a payment on it because it's not required. The whole concept of reverse mortgages, like I said, is you never have to make a mortgage payment on it. That's one of the beauties. That's why people get this loan. Now, this scenario also is about a couple that doesn't really need the money. And I've done lots of loans for people like that. This is, I guess you'd classify it as a lifestyle type choice to get the reverse mortgage because they want to live a certain lifestyle and they don't want to burn other assets to do it. So let's continue on. He says, this $100,000 debt balance makes us all squirm. It just feels different than the first scenario where the trip was paid for by selling assets, right? This is debt. There's interest. The bank took $100,000 of my equity, even though I only borrowed $50,000. They're stealing my home equity. That's the way a lot of people think about it. It's funny because I've talked about this before, but I called a customer of mine who took out a loan in 2021. And he said, when interest rates were at 2.5% or 3%. And the way reverse mortgages are with the line of credit program, that's on an adjustable rate. And the rate has gone up to like 6%. And he's like, boy, the interest really accumulates on this. And I'm thinking, well, his payment, I think used the reverse mortgage to pay off his mortgage and give him some money for improvement of his house. And he also has a line of credit left over. So we were talking and I said, well, yeah, your loan balance has gone up, but the value of your home has increased more than the growth of the loan balance. Plus, his mortgage payment was over $1,000. So over this 4 years, he's kept in his pocket over $50,000 in the same tune and living a lot less with a lot less stress because he doesn't have to worry about making that mortgage payment every month. He still has to pay his taxes and insurance, but he's kept all that money in his pocket that he otherwise would have paid. Now, he could have paid the reverse mortgage, and that would have kept the balance down, but kind of defeats the purpose for his scenario. And so we kind of talked about that, and I kind of showed him how it's easy to forget the benefits of it when you're only looking at one side of the column. You've got to look at both sides, the asset and the liability. He's only looking at the liability side. He forgets, oh yeah, I've got my house, which is appreciating, and I'm keeping that extra money in my pocket, which reduces stress and helps me live a more comfortable life. I could spend that money on other things, or I can invest it. So there's different options he has. So we got to keep that in mind because so many times all we look at is the liability column. And when I'm talking to people, I always tell them, every month you're going to get this statement in the mail and you're going to see that loan balance getting bigger and bigger and bigger if you choose not to make a payment, because this is a payment optional program. And most people choose out of that option of making a payment. They don't want to. So that loan balance is going to get larger over time. Over 10 years, that $50,000 grows to $100,000, or the $200,000 you take out might grow to $400,000, if you choose not to make a payment. So you have to be aware of that. And that's why I always tell people the amortization schedule that I show them when we're deciding on whether or not it's a good fit for them. I always say the benefits you get from this reverse mortgage have to be greater than the negative feeling you get when you open that statement and see that loan balance getting larger. The benefits have to outweigh the cost in your mind. And if they don't, you should not do the reverse mortgage, because the whole goal of the reverse mortgage is to relieve financial stress, not create it. And if it's going to create more stress than it relieves, you shouldn't do it. But I think what happens a lot of times, I don't know how many over time, but it's happened multiple times, probably dozens of times over the 20 plus years I've been doing this. I talked to somebody about it and they, I don't really like that amortization schedule. I don't like that loan balance getting bigger and bigger. And then 3 years, 4 years later, they call me back. I'm thinking about this and I think it might work for me now because their situation's changed. They're tired of making a mortgage payment. Think about it. If you were 70 years old or even 65 in 2020 and you got a great rate, you refinanced it at 2.5% or 3% on a 30-year mortgage, you're making that payment for the rest of your life. As long as you live in that home, you're going to be making that payment. Over a 30-year term, odds are you're not going to live to 95. You might, and then you could celebrate having a paid-off mortgage. But think of all the stuff you've given up over that 30 years that money could have been used for if you got a reverse mortgage to pay it off. I mean, how many trips didn't you take to visit grandkids? How many presents didn't you buy for family or friends? How many events have you missed because you didn't have the cash flow every month to go out to dinner or to join a club because the dues every month were $50 and that was more than you felt comfortable spending? Or maybe you're driving kind of a beat up car like I do. I like old cars, like I said, but maybe you're driving an old beat up car because you don't want to make the payment or you can't afford the mortgage, the car payment and full insurance on that payment as well. So you've got to think about the things that you're giving up on the other side of the equation. You're only looking at one aspect of it. You've got to keep it focused. Okay. Let's get back to the article. See if I could find my, where I'm at. Okay. By fundamentally and importantly, from a net wealth perspective, this loan isn't any different than selling the asset and giving up future growth. The balance sheet is the same. It doesn't care. Yes, by borrowing the money 10 years ago, you now have a $100,000 liability. However, you kept the investment intact, which are now $100,000 larger than if you sold it 10 years ago. This concept is so fundamental in grasping the value of reverse mortgages that I refer to it as the most important thing. This is Brady talking. He refers to it as the most important thing. On a side note, notice that nothing taxable has happened by borrowing against the asset, whereas selling investments often comes with tax consequences. This concept is precisely why almost all permanent life insurance policies have loan features built right into them. It's a brilliantly simple way to save significant money on taxes. In other words, you borrow the money. That's the way rich people don't pay taxes. You hear about all these people, they don't pay taxes because what they do is they use their stock as collateral, like whether it's Bill Gates or Elon Musk or whatever, they use stock in their company as collateral and they'll borrow millions of dollars against the value of the stock and they live off that. They don't have to sell the stock and that way they're not paying taxes. However, one thing you really should be aware of is, there could be fees and taxes when you sell assets, okay? But if you're going to count that, you also have to count there are closing costs with loans and reverse mortgages especially. There are closing costs to factor in. So both of those kind of counterbalance each other, I guess, is the way I like to put it. By the way, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Manager with American Liberty Mortgage here in Denver. You can reach me directly at 303-467-7821. That's my direct line, 303-467-7821. Most of the time I've got it forwarded to my cell phone. But please call me at that number. You can also visit me online at reversemortgageradio.net. reversemortgageradio.net. If you did just tune in, this show will be posted on my website in a podcast format by Tuesday or Wednesday of next week. So you can listen to the entire show then as well on my website. You can also download a free consumer guide on my website. You can get a free quote. You can learn a lot of information about reverse mortgages and see other customer testimonials as well. Okay, now Brady continues on in the article. Let's get back to our couple who celebrated their 50th wedding anniversary. Let's examine their financial situation 10 years later at age 85. Their $1 million home has a reverse mortgage with a $100,000 balance. Is this a problem? An emotional one, probably. Most people would feel like they'd made a terrible mistake by borrowing $50,000 when 10 years later they owe $100,000. But as strong as those emotions are likely to be, the problem is only emotional. They have $900,000 of home equity, and the investment portfolio is $100,000 larger, plus the tax savings inherent in this strategy, because they didn't touch it for that anniversary bash a year ago or a decade ago. The strategy of borrowing against assets rather than selling them is one that wealthy families and businesses have been using for hundreds of years. Their planners and accountants understand the basic concept and employ it regularly. And with no small effort from well-meaning financiers, actuarials, and accountants, it's now been made readily available for the masses through reverse mortgages. And we tend to look down our noses at it like it's somehow beneath us because it's debt. That's the way most people look at it. And then he continues on. He says, so in my experience, the strongest headwind that HECMs face is the public's misunderstanding of this fundamental issue. Debt, like fire, is a powerful tool. Yes, it can be destructive if not understood and respected, but it can also add, tremendous benefits to our lives. In fact, nearly all of the trillions of dollars in wealth that exist as home equity would not be possible without the use of debt somewhere along the way. Strong evidence that debt can be, and quite often is, constructively quite constructive. So if you think about it, look back at your home purchase history. 20 years ago, 50 years ago, whatever it may be, your first house. You may have borrowed a ton of money to do it. You may have borrowed money from relatives to get enough money so you didn't have to pay mortgage insurance, like I did from my dad. I borrowed money to put down so I didn't have to pay the mortgage insurance. And he charged me 10%. He was a financer. So he said, hey, this is the way it is. I charge everybody 10%. That's the way it is. Now, of course, that was back in the 90s when it wasn't that. It was still higher than it should have been, in my mind. But if you look back, you probably, even if you own your home free and clear now, you use debt at some point to start that process. And then you paid it down and probably paid it off. Or you sold your home, you bought a new one, got more debt, and you bought a new one. And because 80% of my customers still have mortgages on their home. Some of them owned it free and clear at first for a while, and then they had to borrow to help out family or to help themselves. Okay, let's finish this article real quick. In a nutshell, a HECM simply makes home equity liquid. Yes, there's interest involved, but that's fundamentally the same thing as selling portions of investments and missing out on future growth. Again, your balance sheet doesn't care. It's how money works and how it's worked nearly since its inception. We must address this more completely and competently and more regularly. Once financial planners and the public become comfortable with this concept, the HECM then sells itself. It makes an illiquid asset, the equity in your residence, liquid. And when it is seen this way, with a proper understanding of debt as a valuable financial tool, no one in their right mind would prefer a larger portion of their wealth remain illiquid when making it liquid is an option. Okay, that's the article. Real quick, I do want to touch on Brady's book because he wrote a book called Reverse Mortgages, The Financial Ugly Duckling. And he talks about some things in there on page 128. He talks about why not use the equity. Now, this is a little bit of a different scenario, but it's the same concept, really. He says there's another way of thinking about the HECM from a lifestyle perspective. I feel it's best phrased by the question, why not use the equity? If you do not feel obligated to leave equity to heirs, or if you have no heirs to leave money to, what's the point in dying with wealth? That could be asked of an investment portfolio, and it applies equally to equity in the house. In case you hadn't heard, you can't take it with you, so why not use it while you're here? And then he goes on to say, I've met retirees who didn't visit their children or grandchildren as much as they'd like because they can't afford it. But they own a $700,000 home with a traditional mortgage of $150,000 that cost them about $1,000 a month in principal and interest. What's the point of this? If they replace that $150,000 mortgage that cost them $1,000 a month with a HECM, they'd have an extra $1,000 a month payment to do with as they please, including visiting their children's families. Additionally, they'd have available and growing line of credit of about $100,000, depending on their age and interest rates and all that. They could use this for other things. Again, these figures are based on the couple's ages and rates and all that. So, in a nutshell, using a reverse mortgage to enhance your lifestyle also could enhance your family's lifestyle too. Because most people, and this is what kills me, people say, well, I really want to leave something for my kids. Most of the adult kids say, Mom, Dad, use it. Take it all. I remember my dad, when they used to do these road trips to visit me and then my sister in Arkansas and then friends down in Texas. They lived in California at the time, and they'd drive up and I'd say, hey, Dad, how's it going? He's like, oh, just spending your inheritance. I say, spend more, because he was kind of cheap, but he was a great guy, and he saved a lot of money and left my mom in a great position now that he's gone, unfortunately. But I'm not waiting for my mom to die so I can inherit any money. That's not the way I think. And I believe that 99 out of 100 people feel that way. In 22 years of doing reverse mortgages, I could count on one hand the number of times adult kids have kind of put the kibosh on parents not getting a reverse mortgage because they didn't want them to spend the equity. But I can't count the number of times that adult children have researched reverse mortgages and tried to talk their parents into doing it to improve their lifestyle, okay? Because it just makes so much sense for people when you think about it and don't get hung up on the fact that you're borrowing money. So anyways, I recommend this book, Reverse Mortgages, The Financial Ugly Duckling by Brady Mullen and Dan Mullen. That's his brother, who's a CPA. This is a very good book. Brady's a high-quality person. He's been in finances for years. It's a fantastic book. In fact, I've got a couple extra copies. I think I've got like 2 or 3. If you want to reach out to me, call me and give me your address. I'll mail you a physical copy for free. I won't charge you anything. It's call me at 303-467-7821. Of course, I'm not going to buy any more for you or something, but they're like $15 on Amazon. But if you want a free one, I'd be happy to send it to you. 303-467-7821. My name is Bruce Simmons. I'm the reverse mortgage manager with American Liberty Mortgage. You can also visit me on reversemortgageradio.net. That's my website, reversemortgageradio.net. Thanks for joining me today. I hope you have a fantastic day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821 or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.